using cost-benefit analysis to identify the optimal capital structure.
The measurement of the costs and benefits of debt represents a significant advance in capital structure research. In an upcoming paper, Van Binsbergen, Graham, and Yang take these measurements further, using them to identify an optimal level of debt for individual firms. 25 The foundation of this new model is that capital structure is optimized when the marginal benefit of debt is equal to the marginal cost of debt. By modeling the characteristics and behavior of firms that seem to operate under optimal capital structures, the authors built a general model to estimate both the benefits, tax shield and reduction in agency costs, and costs, financial distress costs, of debt that can work for any firm. In addition to consideration of the marginal tax rate, the model accounts for tax loss carry-forwards and carry-backs. The model incorporates several variables in modeling the costs of debt, including collateral, physical assets plus inventory divided by total books assets, book-to-market equity ratio, intangible asset ratio, and cash flows to book asset ratio. The model also considers whether a firm pays dividends. Outcomes from the model are consistent with empirical studies and common sense inferences. For example, the model predicts that firms with a low collateral ratio will have higher costs of debt than those with a high collateral ratio. Figure 8.1 depicts the cost and benefit curves for Six Flags and Performance Food Group. Relative to the optimal capital structures determined by the model, Six Flags was overlevered and Performance Food Group was underlevered. The shaded areas depict the net benefit, cost, of debt. For Six Flags, it indicates a net cost of debt since the firm's actual debt level is greater than the optimal level, the costs of debt exceed the benefits of debt. In contrast, Performance Food Group uses too little debt. The shaded area depicts the amount by which the benefit of debt exceeds its costs. Note that at the optimal level, the marginal benefit of debt equals the marginal cost of debt, and debt levels beyond this point will have a net cost. The model can also measure how the cost of debt and firm value are affected by operating with a suboptimal capital structure. 26.